Bitcoin is pumping, but the network is completely silent, and that's not normal. At $120,000, you'd expect soaring fees, mempool congestion, and retail mania, but instead, miners are making less from transaction fees than ever before. So what's going on? Well, in this video, I'll dive into the hidden signals coming from Bitcoin's mining ecosystem, including revenue trends, volatility, and off-chain activity, to uncover what the data is really telling us about this strange rally and where it might go next. We're kicking things off with two powerful indicators that help decode miner behavior by analyzing hash rate dynamics. And right now, both are flashing a major warning. For those that don't know, hash rate is a measure of how much computing power is being used to mine and secure the Bitcoin network. It shows how many guesses, or hashes, are being made every second to try and solve the next block. A higher hash rate means more miners are active, which makes the network more secure but also more competitive. So each miner earns less unless the price goes up or costs go down. The miner capitulation indicator measures the momentum between short and long-term hash rate moving averages, highlighting when miners are likely powering down their rigs, which is a classic sign of stress. The miner capitulation risk metric takes that raw signal and then normalizes it over time, giving us a smoothed risk score from 0 to 100 that shows just how extreme that stress is relative to recent history. When we combine these two, we get both the direction of miner behavior and the severity of the stress they're under. And what's striking is this: even with Bitcoin trading near its all-time highs, these tools are pointing to one of the deepest miner capitulation phases in years. Now, on the surface, it makes no sense. But once you zoom in on the mechanics of miner economics, it becomes very clear why capitulation can occur even at all-time highs. Over the past year, the Bitcoin hash rate has exploded. Miners have added massive amounts of computational power, often financed through debt or outside capital, all betting on higher prices. But here's the problem: as hash rate increases, so does network difficulty. That means the same block rewards get split among more miners, reducing the earnings per machine. So even though the price is high, the revenue per terahash per second, which is essentially the income generated per unit of computational power, has dropped significantly. More miners are fighting over the same pie, and it gets worse for those who expanded aggressively during the previous cycle. Many of them are still servicing debt, and those interest payments don't disappear just because the price goes up. If mining revenues aren't covering those fixed costs, they're forced to liquidate Bitcoin, shut down hardware, or restructure operations, all of which can show up in these capitulation indicators. So, the key takeaway is this: price doesn't always equal profitability. High prices don't guarantee high margins when difficulty, costs, and competition rise even faster. But let's zoom in on miner revenue in more detail, because as always, the picture is more nuanced than this. Right now, daily mining revenue is sitting at over $53 million a day, which is almost on par with what miners were earning at the peak of the previous cycle's all-time highs. This metric is primarily driven by two things: price and block subsidies. And just to recap for anyone new to the terminology, the block subsidy is the amount of new Bitcoin created and awarded to miners each time a block is added to the blockchain. It's the main way new Bitcoin enters circulation, and that reward gets cut in half roughly every 4 years during the famous halving event. We saw this play out very clearly last year. Daily mining revenue was tracking the price and hit a peak of about $60 million per day. Then, almost overnight, it plunged to around $27 million following the halving. That's the brutal nature of this industry. One day you're printing profits, the next your revenue is slashed in half instantly. Now, despite that, miners are incredibly resilient. They always find ways to adapt. Some of the most innovative energy solutions in the world are coming out of Bitcoin mining, whether it's tapping stranded gas, hydro, or weird renewables in far-flung places. But even with that ingenuity, there are headwinds. For many miners, especially in the US, electricity prices have gone up post-pandemic. Hosting and maintenance fees have climbed too. So even if Bitcoin is pumping, net margins may still compress, especially for operators with higher costs or older equipment. That's why miners are constantly investing in research and development to build ever more efficient machines. The latest generation ASICs are far more efficient than older models, which creates a kind of split in the market. Large-scale miners with access to cheap power and the newest rigs can survive, while smaller or outdated players get squeezed out. And that's exactly how you can get localized or sector-wide miner capitulation even during a bull market like this one. So, what's the actual health of the mining sector right now, and is the network under real stress? To answer that, we can turn to my miner revenue strength metric. This tracks the strength of miner income by calculating the relative value of the revenue they're generating, based on the number of new coins mined each day, multiplied by the current Bitcoin price. This gives us a quick, high-level view of whether miner revenue strength is building or breaking down over time. And interestingly, the current reading paints a fairly neutral picture, sitting right in the middle. In other words, we're at a historically average point for the typical miner. This is nowhere near the collapse in strength we saw post-halving, or during the sharp pullback in price a few months ago. What this shows is that mining metrics are nuanced. Relying on a single indicator to form your entire view of the market is a costly mistake. There are so many variables at play, and each mining operation is impacted differently based on scale, location, energy strategy, and hardware. What we're really after is a broad sense of sector-wide health, and this metric helps deliver that. It doesn't tell you which individual miners are winning or losing, but it gives you a solid overview of the ecosystem's overall stability. Next, when we look at mining revenue volatility, we're actually starting to see signs of strength building in this rally. This metric tracks how unstable or variable daily Bitcoin mining revenue has been. It uses a standard deviation function to measure how much miner income fluctuates from day to day. Higher values means more erratic revenue. And historically, those spikes in volatility tend to coincide with major stress events. In fact, the two most extreme points on the chart are the post-halving revenue crash last year and the China mining ban in 2021. When China's share of global hash rate dropped from nearly 75% to effectively zero in a very short period of time. Right now, volatility is increasing again, but this time it appears to be upside volatility as Bitcoin continues pushing deeper into price discovery. This is a key metric to watch, especially when it comes to identifying forced selling pressure or global mining instability. Sudden swings in revenue can create stress, but in this case, it looks more like miners are adapting to a rapidly improving price environment rather than being overwhelmed by it. There's one last thing that is particularly interesting that we'll touch on. Miners earn revenue from two main sources: the block subsidy and transaction fees. As we saw earlier, the block subsidy is the fixed amount of new Bitcoin created with each block, currently 3.125 Bitcoin after the most recent halving. But on top of that, miners also collect transaction fees paid by users who want their transactions confirmed quickly. These fees fluctuate depending on network activity and demand for block space. Together, the block subsidy and fees make up total miner revenue, and as the subsidy continues to decrease every 4 years, fees are expected to play an increasingly important role in sustaining miner profitability. But what is interesting at the moment is the ratio between what miners are earning from their block subsidies to the transaction fees has been dropping like a stone recently. In fact, I'm having to change this to a logarithmic scale to even make it visible on the chart. Now, for every major rally in the past, especially those ones near the cycle peak, the transaction fees start to dominate the miner revenues, as seen by the red colors on the charts. This is because network activity spikes, block space gets congested, and users bid up fees to get their transactions confirmed, resulting in transaction fees making up a significant portion of miner income. But today, despite trading at all-time highs, the fees are almost a negligible part of the revenue stream. But why could this be happening? Well, a potential answer is that much of the market activity is now happening off-chain. Centralized exchanges batch transactions and reduce blockchain footprint, Some custodians move their Bitcoin internally without touching the blockchain, and emerging layer 2 solutions, like the Lightning Network, allow fast Bitcoin transfers without congesting the base layer. But it doesn't mean it's over forever. The reality of the whole situation with Bitcoin at the moment, and not just to do with miners, is that the network is very quiet despite some significant price appreciation in recent months. As I've said many times, the retail crowd is still asleep, but the price and the hash rate are going stronger than ever. It's only a matter of time before we see this ratio pick back up again. It's just another tool in my shed that points towards further price appreciation ahead. I'm trying to stay level-headed with it all, and I am happy to be wrong. But I did not expect the network to be this quiet at a $120,000 Bitcoin. We're in a phase where Bitcoin's price is booming, but block space demand is not. It shows that those who are still here have extreme conviction and are happy to wait until much higher prices. It's an exciting time to be an observer of the network, and I'll keep you posted if anything flashes out of the ordinary. I'll also be releasing a few major updates to my indicator suite in the near future that will include these minor metrics covered today, so stay tuned. So to wrap things up, the data right now is painting a really nuanced picture. Yes, we've seen some signs of minor capitulation, but it's not all doom and gloom. In fact, some of the underlying metrics, like revenue strength and volatility, suggest that miners are actually finding their footing again and adapting to the current environment. It's definitely not stress across the board. That said, just because Bitcoin is trading at all-time highs doesn't mean it's smooth sailing for everyone. Profitability still depends on a bunch of factors: energy costs, hardware efficiency, and even debt levels. So, while some miners are thriving, others are being squeezed by rising computational difficulty and compressed margins. It's a reminder that high price alone isn't enough to guarantee survival in this game. And what's probably the most fascinating part of all this is how quiet the network still is. Fees are unusually low, block space isn't congested, and on-chain activity feels like it's waiting for something. It really reinforces the idea that the retail crowd hasn't fully arrived yet. But those who are here are showing serious conviction. To me, that's a loud signal hidden in the silence, and it suggests we're far from done. If you're serious about Bitcoin analysis, my full custom indicator suite is now live, built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.